You see the headlines, right? S&P 500 hits a new high. And you probably think, wow, the whole market is doing great. But what if I told you that's not really the full story? What if the health of the entire index, this key benchmark we all watch, is actually just an illusion, created by a tiny handful of giant companies? Well, let's pull back the curtain and see what's really going on.
So this is the big question we're going to tackle today. Who really controls the market? You'd think with 500 companies in the index, it would be this big collective effort. But the reality? It's much, much more concentrated.
The answer, believe it or not, comes down to this number right here. 7. Just 7 companies that hold an almost unbelievable amount of power over the entire S&P 500. And the scale of that power is just staggering. As of 2024, these 7 giants, we're talking Apple, Microsoft, Amazon, Alphabet, Nvidia, Meta, and Tesla, they make up nearly a third of the index's total value. Just think about that for a second. The performance of 493 other companies is basically overshadowed by just 7 of their peers.
So how is this even possible? Well, it all comes down to how the S&P 500 is built. It's what's called a market cap weighted index. It's not a simple average where everyone gets an equal vote. Nope. In this system, the bigger you are, the more your stock's movement pushes and pulls the entire index. It's a system literally designed to reward size. And right now, size is incredibly concentrated at the very top.
So, how did we even get here? How did this small group of companies get so powerful that they can sway the entire market? Well, it's a classic story of going from the garage to global domination. And it's a fascinating story because every single one of these giants started out small. We all know the legends, right? Apple in a garage, Amazon packing books on the floor of a rented home, and Nvidia actually came dangerously close to bankruptcy in its early days. Their journey from that to where they are now is just remarkable.
And they followed a pretty powerful playbook to get there. First, relentless innovation. They weren't just creating products, they were building entire ecosystems, like the iPhone or Amazon Web Services. Second, they mastered network effects. The more people use Facebook, the more valuable it became for everyone. Third, aggressive global expansion. But 2 other factors were like pouring rocket fuel in the fire: access to tons of cheap money for acquisitions, and the powerful financial tool of massive share buybacks.
And when we say massive, we really mean it. To put it in perspective, Apple alone has spent over $650 billion on share buybacks since 2012. That's more than the entire value of most companies on the planet. And what this does is reduce the number of shares available, which helps drive the stock price even higher. If you want a perfect example of this explosive growth, just look at Nvidia. Back in 2015, it was a solid company, worth about $12 billion. Okay, not bad. Fast forward to today, fueled by the AI boom, and its market cap has just skyrocketed to over $2.1 trillion. That is a 170-fold increase in less than a decade. It's just mind-blowing.
But here's the thing. When a company gets this huge, it doesn't just participate in the market anymore. It starts to actually distort it. It creates an illusion of strength in the very index that's supposed to measure the economy.
Let me show you how this works in practice. If Apple's stock goes up just 1%, its immense weight can drag the entire S&P 500 up with it. Now compare that to a smaller company in the index. Let's say that company has an incredible day and its stock doubles, 100% gain. The impact on the overall index is so tiny you would barely even notice it. This is what creates that massive illusion, and 2023 was a perfect case study. The S&P 500 index surged to new highs, looked fantastic, but the reality for the majority of its members was completely different. An incredible 72% of the companies in the index actually had flat or even negative earnings growth.
I love how one analyst put it. He said the index was dragged higher, kicking and screaming, by the phenomenal performance of just a few of these tech giants. In other words, the index didn't rise because the broad market was healthy. It rose because a handful of companies were just so strong they could pull the entire average up, masking all the weakness everywhere else.
And this leads to a really worrying disconnect, right? A disconnect between the headline numbers you see on the news and the actual economic reality for a lot of people and businesses.
So on one side, you have the headline index hitting all-time highs, painting this picture of incredible prosperity. But on the other side, you look at indicators that better reflect the domestic Main Street economy, like small cap stocks, and they're lagging far behind. And we're seeing a rise in loan defaults among small businesses. 2 very different stories.
And look, this isn't just about small business. For millions of Americans, the economic picture looks very different from the stock market. Just look at household debt. American credit card balances have hit a record-breaking $1.3 trillion.
And this number just reinforces that story. Nearly 60% of Americans are living paycheck to paycheck, struggling to keep up with the cost of living. So yeah, the stock market looks strong, but for many, the real economy doesn't feel strong at all.
Okay, so what does this all mean for you as an investor? How should you navigate a market that's so heavily tilted by just a few big players? All right, let's talk strategy.
The most important takeaway is this. Investing in an S&P 500 index fund is not the truly diversified strategy it once was. With nearly a third of its value in just 7 companies, it's actually incredibly concentrated. If those top stocks take a hit, the whole index goes down with them. The old saying has never been more true.
So to truly diversify, you have to start looking beyond the giants. That means exploring mid-cap and small-cap companies, which offer totally different growth profiles. It means considering value sectors like industrials or healthcare that sometimes get overlooked when tech is soaring. And it means looking for opportunities outside the US for genuine international exposure.
And it's also important to think about what's next. Where could that next wave of giants even come from? Well, key trends point towards the sectors that are building the foundation of our future economy. Things like AI infrastructure, advanced chip manufacturing, robotics, and of course, cybersecurity.
So, here's the crucial point. The one thing to remember, the S&P 500 is not the economy, and it's not even the market in the broad sense anymore. It has become a performance tracker for its biggest, most dominant winners.
So the next time you see that news flash that the market is soaring, just pause for a second and ask yourself this critical question. Understanding that distinction, that difference, well, that's what separates a passive observer from a smart, informed investor.